Are hedge funds a scam? Hedge funds are one of the world's most lucrative financial instruments. However, they are also among the most risky. They are an essential part of some of the richest people in the world, but they also have their share of problems, mainly fraud. The hedge fund industry is rife with scams, some on a grand scale like Bernard Madoff's $50 billion Ponzi scheme. To make matters worse, hedge funds are often poorly regulated and carried out by inexperienced individuals. Critics argue that they are an investment scam because they provide the unrealistic returns that the firms promise their investors. Others argue that hedge funds are not as bad as people think because they give an opportunity to those who cannot afford investing in other ways. They also say that hedge funds offer a stable and secure place for people to invest their money, even if it is not a perfect alternative. It's impossible to answer this question without considerations of what kind of investor you are and what your investment goals are. Welcome to Stocks Galore, the place for those in passionate pursuit of financial freedom. Smash the like button now, subscribe to our channel, and click the notification bell to be notified when new videos are released. Hedge funds are managed investment vehicles that invest in stocks, bonds, and other financial instruments that are considered to be speculative. They are generally considered as private investment firms that provide capital to investors who cannot invest on their own due to either inexperience or limited access to capital. The hedge fund industry has grown exponentially over the last few years, with over $4 trillion in assets under management in 2021. It's an exciting yet complex industry, with its own vocabulary and many risks associated with it. Before investing, it's important to do your research on hedge funds so you can make an educated decision on whether or not this is the right investment for you. One of the most important things you should understand about hedge funds is their structure and how they operate. How hedge funds work. Hedge funds are often perceived as being different from other types of investment firms because they typically invest in alternative assets, such as hedge fund managers' own money and/or open-ended mutual funds that do not have market-based pricing mechanisms. Hedge funds also differ from other types of financial firms because they do not issue stocks or bonds for resale. The hedge fund industry has been around for decades, but has only recently seen a rise in popularity. It took off after the financial crisis as investors sought to keep their money safe from falling stock prices and corporate bankruptcies. With this increase in demand, hedge funds have been able to grow rapidly, diversifying from traditional investments, such as stocks and bonds, to alternative investments, such as real estate and cryptocurrency. Hedge funds have historically been associated with short-selling stock shares or other securities, playing the market by buying shares when prices are low and selling them when they're high to make a profit. They also employ very different strategies, which include market making and hedging. Quarterly performance for hedge funds can vary from positive to negative depending on factors, including how well the markets perform and how well they hedge their portfolio against risk factors. How does a hedge fund make money? Hedge funds make a lot of money by investing in various markets and industries. However, it is difficult for them to make a profit in some cases. These are the 3 ways hedge funds make money. 1. Real-time trading. 2. Shorting stocks. 3. Leveraged investments. Hedge funds use many different strategies to generate their profits with greater variety than any other investment firms with the exception of banks. They work with 2 main types of strategies: long and short trades and risk arbitrage. They use derivatives as a way to manage risk and increase profits. This is achieved by taking long positions and short positions on certain assets such as stocks, bonds, currencies, commodities, and other financial derivatives. They also use other hedging techniques, such as hedging against adverse market movements or foreign currency risks, by expanding the portfolio through investments in stocks and bonds outside the scope of the original hedge strategy. This helps the hedge funds avoid losses from an immediate drop in one asset's value while still increasing their profit potentials. Here are some of the other ways that hedge funds can generate income. Investing in riskier securities and the company's debt. This makes them potential lenders if the company defaults on its debt. This can also be risky because if they're wrong about a company's prospects or it goes bankrupt, they can lose all of their money. Making loans to companies. This is one way that hedge funds make money by earning interest for providing capital for companies through loans. If they are successful, they will earn the interest on the loan amount for as long as it is outstanding. A brief history of hedge funds from the Great Depression to today's financial crisis. The hedge fund is a type of asset management company that is primarily focused on long-term investments and trading strategies. Today, Hedge funds are at the center of financial crisis. Hedge funds had been seen as one of the most prominent and successful financial institutions in the world before recent events. However, there are now questions about how well they will be able to perform in the future. At its core, hedge funds are designed to take on risk by utilizing complex trading strategies to generate returns for its investors. The use of leverage allowed hedge funds to assume large amounts of debt without their underlying assets being at risk, which was one reason why hedge funds were so successful during good times but became a problem during bad times when it came time to pay back that debt. The hedge fund industry grew in the last quarter of the 20th century when it became an asset class that was not necessarily correlated to stock or bond prices. This led to a boom in the number of hedge fund managers who are now held accountable for their decisions. Hedge funds are still an attractive asset class, despite the recent market volatility and financial crisis. Best way to make money with hedge funds. Hedge funds are not just for rich individuals anymore. Now, you can invest in hedge funds through a number of different avenues, including online brokers, mutual funds, and even ETFs. There are so many ways to make money with hedge funds now that it is hard to keep track of them all. There are many benefits to investing in hedge fund stock shares, including high returns and the potential for solid investments down the line, but there is also a lot of risk involved with these ventures. One should be careful when considering this option and should do their research before committing money into this type of investment opportunity. The most important thing to remember is that the hedge fund industry is extremely volatile, so you must be willing to take risks and be comfortable with losing money. Benefits of investing with a risk-averse management team. Investing with a risk-averse management team can boost returns and lower the volatility of a portfolio. Investing with a risk-averse management team can help boost returns and lower the volatility of a portfolio. The company's willingness to maintain their cash level while many other companies raise capital indicates that they are not going to rely on short-term gains for growth. This puts investors into an advantageous situation when it comes to finding investments with high returns and low risk. A risk-averse management team is one that is comfortable holding onto excess cash in anticipation of better times ahead for the company. It also means that the company doesn't need excessive debt, which is good for investors who want more predictable and stable portfolios. When a hedge fund team has a low risk tolerance, they tend to invest in safer investments. This can be risky because it could lead to underperformance. How risky is it to invest in a hedge fund? It is not uncommon for individuals to make mistakes when investing their assets, but it can be even more difficult to make sound decisions when the market is volatile. Hedge funds carry with them a certain level of risk that comes with investing in a private company. There are countless risk factors that come into play when investing in a hedge fund. These include economic conditions, political changes, and changes in the company's business model or strategy. In addition to this, there are other risks such as losing money on poor investments, short-term fluctuations, and liquidity issues that can affect your pension plan should you decide to invest in hedge funds. Investors are often afraid to invest in hedge funds with their high operating costs and potential financial loss. It is hard to know what the return of a hedge fund will be. There are no standards for their return, so it is too risky to invest your money in them. Investing in hedge funds with confidence, not fear and anxiety. The hedge fund industry is a volatile one, and that's what makes it so intriguing. Investing in hedge funds with confidence, not fear and anxiety is a tough choice. One of the main reasons why investors are hesitant about investing in hedge funds is their lack of transparency, which means investors cannot know how their money is being managed. However, there are different ways to gain access to this information, including by meeting with the investment manager directly or visiting an online platform that has all this information available to users. The need to do thorough research in order to make informed decisions about hedge fund investments is what I'm emphasizing in this video. What you need to know before investing in hedge funds. In today's market, hedge funds are becoming more and more popular. Many people across the globe invest their money into these funds because of its lucrative returns. In order to invest in a hedge fund, one needs to take the following factors into account. How risky is the investment? How much does it cost? What might happen if it doesn't work out? Is the management team reputable and credible? Is there a personal connection with your advisor or a mentor involved? Are you investing with confidence or fear and anxiety? With many hedge fund managers, it is hard to tell if the fund has been performing well or poorly. However, there have been a few hedge funds which have emerged as favorites amongst investors. The top 3 most popular hedge funds are Bridgewater Associates, Renaissance Technologies, and 2 Sigma Investments. Each of them has a successful track record, and they have all outperformed the S&P 500 index for at least 1 decade. Pros and cons of hedge funds. Not all hedge funds are created equal, and some may be scams. If you're considering switching from your average 401k or mutual fund, do your research first to make sure you're not jumping into the wrong investment as quickly as possible. Here are some of the pros and cons of investing in a hedge fund. Pros: hedge funds have a higher success rate than mutual funds, ETFs, and other types of investments. A hedge fund manager may have been able to outperform their peers because they have more time to study stocks, spread their bets across multiple industries, buy shares in companies that are low risk and high reward, or use automated trading programs to trade on their behalf. Cons: high fees, no transparency. Unrealistic returns, limited access to capital, high risks of losing all of your money. 5 reasons to doubt the claims in a hedge fund pitch book. There are many examples of claims that too closely mirror what is happening in the market when they are simply not true. There are, however, 5 reasons to doubt the claims in a hedge fund pitch book. 1. We have seen gains of 200% in the last year. 2. Our success rate has been at 100% since inception. 3. We use proprietary algorithms that allow us to profit from volatility. 4. Our returns have averaged 12% per annum over last 5 years. 5. We have never lost money for our investors. The truth is that they can make money, but the results vary depending on how the fund is invested. Hedge funds are a complicated topic, and it is not always easy to know which investment strategy will be successful. A hedge fund can be used to generate more returns over time, but it requires more risk in order to do that. Why most hedge funds fail? Hedge funds are often thought of as successful investments, but according to data, most hedge funds fail in their investments. The reason for these failures is that most hedge funds are not able to make use of the skill sets that they bring to the table. They fail because they do not leverage their talent appropriately and/or because they lack the necessary resources to do so. Here are some other contributing factors for why they fail. Predicting the future is really difficult. This is one of the reasons that hedge funds sometimes do not perform well at all, because there are too many different variables involved in predicting how an investment will go. Another reason they may fail is because they can be complicated for investors to understand and very personal, which means there is no transparency on how they work. Another contributing factor could be that even though most hedge funds claim to be high-frequency trading firms, most of them actually only make about 10% of their profits through trading, with the rest coming from other methods like asset management and venture capital. 5 reasons why hedge funds are not scam. 1. Hedge funds offer investors lucrative returns, which is why they've become so prevalent in the investment sector. People who invest in hedge funds can earn up to 30% interest on their investments. 2. Hedge funds have an average lifespan of 20 years that keeps them from being too risky for most people to invest in, since they're able to take significant risks with their money over a long period of time without it running out too quickly. 3. Hedge fund managers are highly educated and experienced individuals who know what they're doing when it comes to trading stocks or derivatives, which makes them more reliable than individual investors. 4. They offer diversification over time. Hedge funds offer access to different securities from different industries around the world, which is an opportunity for investors to balance their risk exposure over a long-term horizon. 5. Hedge fund managers take on more risk than commercial firms. Hedge funds offer higher returns than commercial firms. The fee structure of hedge fund managers typically depends on the amount of risk they take on and how well they perform relative to their peers in terms of investment returns. This risk is funded by accepting high-yield investments. This means that while there might be short-term volatility in their performance, they have a high chance of earning significant returns on their investments. Conclusion: the bottom line is that hedge funds should not be considered as a scam. They are a legitimate way for investors to make money without risking their personal financial future or retirement savings. Hedge funds help by providing investors with returns on investment and protection from market volatility. However, they do have the risk of losing your money. Investors should take care to know what they are getting into before joining a hedge fund, as well as what qualifications the manager has before investing. Hedge funds can provide an opportunity for those who want to invest in them without risking their finances, but are not guaranteed to give you back your initial investment. So there you have it. If you enjoyed this video, smash the like button now and subscribe to our channel to be notified when new videos are released.